P Singh, Chairman and MD at Satin Credit Care, joins in on the show right now. Mr. Singh, hi, morning. First of all, congratulations. A strong set of numbers for you. Your disbursements have seen an average run rate of about 899 odd crore rupees. And you've already achieved that milestone of reaching 1,000 crore rupees in terms of disbursements. Do you think this is going to be your monthly run rate soon?
I think, we are now at about 900. So reaching 1,000 crore per month is not a big problem now. The last quarter is always a bigger quarter than the earlier quarters. Hopefully, I think, we'll be able to achieve our 1,000 crore numbers, per month, at least in the last quarter, and then going ahead.
You've also added about 50 new branches in this quarter. Is there any internal target that you may have for branch expansion?
So we are opening up branches. We are opening close to about 150 odd branches in the next year. We are also opening up a couple of states, so we are not present in Andhra Pradesh and Telangana. So we're opening up both the states now in March. We are also looking forward to opening another state in the next year. So hopefully, I think, all these 150 to 170.
How long does it usually take for branches to yield returns?
So technically what happens is when we reach a borrower base of about 1,000 borrowers, the branches get break even. But since the base numbers are pretty large, for us to reach the milestone of making a branch profitable will probably take lesser time as compared to if you have a lesser number of branches. We currently have close to about 1,300 odd branches consolidated. We have about 1,200 branches in Satin Credit Care only. So I think, for us, adding another 50 branches will probably not have too much differentiation in the bottom line also.
Fair enough. Morning now. Your overall OPEX to AUM also may rise, although it's in decline from FY23 levels. What is the outlook for your operating costs from here on?
Yeah, optimum efficiency is coming in. If you look at the borrowers per loan officer, so that has increased from about 440 to about closer to about 445. This will keep a trend, where we will have optimum efficiency coming in by the number of borrowers per loan officer. If that increases, actually the OPEX will start going down from there. And our target for us is that we want to bring down our OPEX now to about 5.5. That's our first milestone which we want to achieve. And I think we're looking at technology as well as optimum efficiency, as well as maybe more depth in the branches where we are working in. So this OPEX, my sense is that this will start coming down from the 5.8 levels also.
Okay, fair enough. What's the outlook given that the credit rating for your company that was upgraded this quarter, given the overall scenario where NBFCs, may see some pressure on cost of funds due to change in risk? Will this upgrade lead to perhaps easing some of that pressure on the cost of funds?
Yes, I think, the cost of funds, as we start now this quarter, I think our conversation with our lenders also is reaching a stage where we are looking at least about 0.25% reduction in our cost of funds, But if I look at the long term with the upgrade in the rating, our sense is that in total, I think we'll be able to achieve a 0.50% reduction in our cost of funds, And this, keeping our margins intact, I think, if we get this reduction, we'll probably be passing it on to our borrowers, but keeping the margin intact, wherever we are right now.
All right. And tell us a little bit more about your asset quality, because it is pretty evident from your numbers that it has improved. What led to this? Will it sustain?
Yeah, this is sustainable because if we look at it, post-COVID, I think our GNPA was about 3.92% last December, in the last quarter as such, December 22 quarter. But looking at this, I think, we've been able to achieve a much better credit asset quality, and I think, moving ahead, since the income levels are fine, the disbursements are fine, the OPEX remains fine. I think, for us, the portfolio quality will hold on. And I think, for us, the guidance which we had given earlier was about 1.25% to 1.5%. And I think we'll be much below that. We're currently at about 1.1%. I think, we're going to remain within this zone, for the future quarters also.
While your credit cost is improving, we're also hearing concerns from the regulator over small ticket size loans. I mean, even when it comes to farming, kharif output was down marginally. What's your outlook here, and what areas you think are going to drive growth for you going forward?
See, if you look at the this current month as such, because of rains, the Rabi acreage has in fact increased, excepting for pulses, which has been down. But if you look at the wheat and the rice acreage, that has increased, which actually bodes very well in terms of the income generating capacities in the farming community as well as in the rural space. Having said that, I think because of the pent up demand, which is now coming up, the MSME business, the micro businesses in the rural space is really looking up. The income levels are increasing. So we feel that I think the demand is very robust, and the growth which we have projected, in fact, we're beating that, will probably be there. And similarly, the credit quality will probably hold on. As I said earlier, basically it's going to be there in the range of about 1.25% at the max, which is going to be there.
All right, good to have you on board. Thanks so much for taking time out and joining in, giving us a viewpoint on how things are shaping up.